Stop whatever you are doing. This morning at 8:30 a.m. Eastern Time, the U.S. government released the most important piece of economic data of the entire month. The April Consumer Price Index, the official inflation report, just dropped. And here is the number that every Wall Street trader, every hedge fund manager, every Federal Reserve official was staring at this morning. Asterisk, 3.7% year over year. Asterisk, let me put that in context for you. In February, before the war in the Middle East started, inflation was at asterisk 2.4%. Asterisk, that was just 3 months ago. In 3 months, inflation jumped from 2.4% to 3.7%. That is the biggest 3-month acceleration in inflation since the energy crisis of 2022. That is the highest CPI reading since January 2024. And here is the thing that nobody in the mainstream financial media is going to tell you clearly today. This number doesn't just affect the Fed. It doesn't just affect bond markets. It affects every single dollar you have invested. Right now today, asterisk next, I am going to break down exactly what this number means, why it happened, what comes next, and most importantly, what you should actually be doing with your portfolio in response. Because the wrong reaction to this data could cost you, the right framework could protect you, and even profit you. Let's get into it. And if you are new here, subscribe right now. Asterisk every Tuesday when major economic data drops, I am here breaking it down in plain English before the market closes. Hit subscribe so you don't miss the analysis when it actually matters. Let's go. Alright, let's start with the raw data, because I want you to understand this report at a level deeper than just the headline number. April CPI came in at asterisk 3.7% year over year. Asterisk that is up from 3.3% in the 2nd of March, 0.4% in February, and 2.7% in January. 4 straight months of acceleration. This is not a blip. This is a trend. On a month-over-month basis, CPI rose asterisk 0.6% from March to April. Asterisk to put that in annual terms. If inflation kept running at this monthly pace for a full year, you'd be looking at 7% plus annual inflation. Now, it won't keep running at that pace, but the direction matters, and the direction is up. Core CPI, which strips out volatile food and energy, came in at asterisk 2.7% year over year, up from 2.6% in March. Month over month, core rose 0.3%. Now, here's why the core number matters so much. When people argue, it is just energy, it'll pass. The core number is their evidence. And they're partially right. Core inflation is not catastrophic. 2.7% is elevated but not extreme. But here's the problem with that argument. Energy prices don't stay contained in the energy bucket. Asterisk, they spread. They flow through transportation costs. They flow through manufacturing costs. They flow through food production and distribution costs. The longer oil stays above $100 a barrel, the more those energy costs leak into core inflation. And we already see it starting to happen. Core services inflation, things like airfares, medical care, restaurant meals, are rising faster than they were 3 months ago. That is the energy spillover beginning. This is the engine driving everything. The energy index surged in April, led by gasoline. Gas prices have risen so fast that they now account for the majority of the overall CPI increase. Right now, the average American is paying asterisk $4.5 per gallon, at the pump. That is up from around $3.2 in January. That is a 40% increase in gas prices in 4 months. Think about what that means for a family that drives 1,000 miles a month in a car that gets 25 miles per gallon. They're buying 40 gallons a month at $4.5 a gallon. That is $180 a month just on gas in January. That same 40 gallons cost them $128. That is $52 more every single month just for transportation, going directly out of their disposable income. And gas prices aren't the only energy story. Utility bills are up. Jet fuel costs, which flow into every airline ticket, are up. Diesel, which powers every truck that delivers every product you buy, is up. Here is something most people aren't talking about today. There is a special factor in this month's CPI report that is artificially inflating the housing number. Last fall, when the government shutdown happened, the Bureau of Labor Statistics was unable to collect housing data for October 2025. They used a carry-forward imputation, essentially estimating October's number. Now in April, because rent surveys are conducted every 6 months, The April data is being compared to last April instead of last October. That technical adjustment is pushing the rent and owner's equivalent rent components higher in this report, above and beyond what actual rent market conditions would suggest. What that means is, part of today's hot CPI reading is a one-time technical effect, not a fundamental acceleration in housing costs. The Fed knows this. Bond traders know this, but it is not going to stop markets from reacting today. I want to take a step back and make sure you understand the root cause of everything we're seeing today, because inflation doesn't happen in a vacuum. There is a specific reason the CPI is at 3.7% today, and understanding that reason is the key to understanding how long this lasts. The answer is the Strait of Hormuz. Let me give you the full timeline, because I think most investors still don't understand how significant this choke point is to the global economy. The Strait of Hormuz is a narrow waterway between Iran and the Arabian Peninsula. At its narrowest point, it is just 21 miles wide, and through those 21 miles flows approximately 20% of the world's oil supply every day. Saudi Arabia, Kuwait, Iraq, Qatar, the UAE, they all export oil through the strait. Iran itself ships oil through the strait. Liquefied natural gas from Qatar, which powers much of Europe, flows through the strait. In late February of this year, conflict between the United States and Iran escalated into a military confrontation. Iran moved to restrict traffic through the strait. The US responded with a naval blockade of Iranian ports. Both sides have maintained their positions, with periodic escalations and de-escalations. The result, roughly 20% of the world's daily oil supply has been disrupted. For over 2 months. Nothing in the modern era, not the 1973 OPEC oil embargo, not the 1990 Gulf War, not the 2022 Russia-Ukraine conflict, has produced a sustained disruption of this magnitude to global energy supplies. Oil went from roughly $70 a barrel before the conflict began to over $106 a barrel at the peak. It is currently sitting around $98, -102, depending on the day's Iran headlines. And oil at $100 doesn't stay in the energy category of your CPI report. It flows everywhere. Every trucking company in America pays more for diesel. Every airline pays more for jet fuel. Every factory pays more to heat and cool its facilities. Every farmer pays more for fertilizer, which is made from natural gas. Every food manufacturer pays more to run its production lines. All of those higher costs eventually become higher prices at the checkout counter. That is how you get from 2.4% inflation in February to 3.7% inflation in April. It is not complicated, it is oil. And oil is high because of the Strait of Hormuz, and the Strait of Hormuz is closed because the US and Iran have not reached a peace agreement. Now, here is the critical question for investors. How long does this last? Yesterday, Trump rejected Iran's latest peace proposal on Truth Social, calling it totally unacceptable. He also described the ceasefire as being on life support. The one-page, 14-point memorandum of understanding being negotiated between Trump's team and Iranian officials has stalled on the nuclear question. Trump wants complete nuclear disarmament. Iran refuses. Goldman Sachs chief economist Jan Hatzius wrote in a client note yesterday that the market is bending, not breaking. The economy hasn't collapsed under the weight of $100 oil, but the risks haven't disappeared either. He cited 3 reasons the economy has held up. Unusually high oil inventories heading into the conflict cushioned the initial shock. Demand destruction in areas like air travel has been relatively painless, and the AI boom has helped keep the stock market elevated. But here is Hatzius's warning. Those cushions are temporary. Global oil inventories are being drawn down every day the strait remains restricted. The demand destruction that has been relatively painless could become less painless as it spreads to more essential goods and services. N&P Global's chief economist put a number on it. His firm's forecast, headline CPI of 5% for full year 2026. In a scenario where the conflict remains unresolved, 5%. That would be the highest annual inflation rate since 2022. JP Morgan went further, constructing 3 scenarios. Even in their most optimistic scenario, where peace talks succeed quickly and oil normalizes rapidly, CPI remains above 3% until early 2027. It is now essentially impossible for the Fed to reach its 2% inflation target before 2027. Regardless of what happens with the Iran situation, I want to stop here for a second and ask you something important. Drop one word in the comments right now. That describes how today's inflation number makes you feel about your portfolio. One word: worried, prepared, confused. Frustrated. I read every comment on this channel, and right now, at our size, I can actually respond to most of you personally. Your comments also tell the algorithm this video is worth showing to more people who need this information. So please, one word, right now, in the comments below. This is the section that I think is most critical for investors to understand, because the Fed's response, or more precisely, the Fed's inability to respond, is what makes this inflation situation different from anything we've dealt with in the last several years. Let me walk you through the trap the Federal Reserve is currently in. The traditional playbook, when inflation runs hot, the Fed raises interest rates. Higher rates make borrowing more expensive. That slows down consumer spending, business investment, and hiring. Slower economic activity reduces demand. Lower demand puts downward pressure on prices. Inflation comes down. That is the classic playbook. It worked in 2022 and 2023, when the Fed raised rates from near zero to over 5%. Why the playbook doesn't work. This time, here is the problem. Today's inflation is not primarily a demand problem. It is a supply shock. Oil is expensive. Not because Americans are spending too much. It is expensive because a critical global supply route has been disrupted by a military conflict. When inflation is supply-driven, raising interest rates doesn't fix it. The Fed can make mortgages more expensive, make car loans more expensive, make business credit more expensive, but none of that reopens the Strait of Hormuz. None of that brings oil back down to $70 a barrel. None of that lowers gas prices at the pump. So raising rates would hurt the economy, slowing growth, potentially pushing unemployment higher, without actually solving the inflation problem. That is the definition of stagflation risk. Current Fed situation, here, is where things stand as of today. The Federal Reserve held rates steady at their last meeting. Jerome Powell's term as chair ended May 15. Kevin Warsh has now stepped into the role on a temporary basis. This leadership transition is happening at the worst possible moment. Markets have completely priced out any rate cuts for 2026. According to CME Group's FedWatch tool, futures traders don't expect any rate cuts at all this year. Bank of America economists have explicitly stated they no longer expect any rate cuts from the Fed in 2026. They've pushed their forecast for the first cut to the second half of 2027. Think about what that means. At the start of 2026, the market was pricing in multiple rate cuts this year. That expectation drove a significant rotation trade, money flowing out of tech and into rate-sensitive sectors like financials, small caps, real estate, and utilities. All of those trades were built on the assumption that borrowing costs would fall. That assumption is now dead. Every investor who rotated into rate-sensitive sectors based on the Fed pivot thesis is now sitting in positions that don't have the fundamental support they were bought for. What the new Fed chair might do, Kevin Warsh is widely considered more hawkish than Powell. His instinct in an inflationary environment would be to lean toward tightening, not easing. If April CPI comes in at or above expectations, Warsh faces immediate pressure to either raise rates or credibly signal that rates will remain elevated for longer. Neither of those outcomes is good for rate-sensitive equities or bonds. The bond market already moved yesterday. The 10-year Treasury yield rose 4.6 basis points to 4.41%, even as stocks hit all-time highs. That divergence, stocks up, bonds selling off, is a classic signal of markets repricing inflation risk. If today's CPI print is in line with or above the 3.7% expectation, watch what happens to the 10-year yield this morning. If it breaks above 4.5%, that is a meaningful signal that bond traders are pricing in a more restrictive Fed than the stock market has priced in. And when bonds and stocks diverge like that, the gap typically closes, and it usually closes by stocks coming down to meet bonds, not the other way around. Bottom line on the Fed. The Federal Reserve is trapped between an inflation problem it cannot solve with conventional monetary policy and a weakening economy. It cannot support with rate cuts. The result is inaction, holding rates steady while watching CPI accelerate. That inaction is itself a form of policy, and the market will need to price it accordingly over the coming months. Let me walk you through what is actually happening in markets today, in response to this CPI print first. The context from yesterday, Monday's session, gave us a preview of how sensitive this market is to Iran headlines. The S&P 500 closed at asterisk 7,412.84 a new all-time high. The Nasdaq closed at asterisk 26,274 also a record. The Dow added 95 points to asterisk 49,704 On the surface, another strong day. But here is what was happening underneath. Only 37.8% of US stocks advanced on Monday. The index hit all-time highs on the backs of a small number of semiconductor and energy stocks, while the majority of the market was actually down. That is one of the thinnest rally breadths we've seen at all-time highs in years. When an index hits records but most stocks are falling, that is not a sign of strength. That is a sign of concentration risk. The semiconductor stocks driving Monday's rally included AMD, which hit all-time highs going back to its IPO in 1972, Intel, which has tripled since late March, Micron at all-time highs, Applied Materials at all-time highs, Corning at all-time highs. This after Nvidia announced an agreement to invest up to $3.2 billion in the 175-year-old glass maker. Energy stocks were also strong: Halliburton, Exxon, ConocoPhillips, all up 1% or more as oil rose. But here is the other side of the ledger. Nike was down 2.56%, P&G down 1.84%, Microsoft down 1.28%, Salesforce down 3%, McDonald's down 2.8%, Home Depot down 1.51%. Notice the pattern: the stocks getting hit are consumer-facing companies, companies that sell things directly to American households, and those companies are getting hit because consumer spending, the foundation of 70% of the US economy, is starting to show stress under the weight of $4.5 gas prices and rising inflation. No for today's CPI reaction. With CPI coming in at 3.7% as expected, the market's reaction will likely depend on whether the number is seen as priced in or as a new shock. Here is how to read the market's reaction today. If the S&P 500 FE opens lower and stays lower FE, that tells you the market sees this as worse than priced in. Traders are repricing the Fed stays higher for longer scenario. If the S&P 500 FE opens lower but recovers FE, that is the sell the news, buy the dip reaction. The market had feared something worse, and 3.7% in line with expectations is actually relief. If the S&P 500 FE opens higher FE, that means the market is reading the core number 2.7% as tame enough and attributing the headline spike entirely to the one-time rent adjustment and energy, which are both seen as transitory. FE watch the 10-year Treasury yield above everything else today. If it breaks above 4.5% on this CPI print, stocks will face real headwinds if it holds below 4.4%. The market can absorb this. And watch oil. Trump rejected Iran's proposal yesterday. Oil was already up 3% heading into today. If oil breaks back above $105 on additional Iran news today, that adds pressure on top of an already hot inflation print. This is the most practical section of the video, because understanding the macro backdrop is one thing, knowing what to actually do with your portfolio is another. Let me walk you through how inflation at 3.7% and rising, combined with no Fed rate cuts, reshapes the investment landscape sector by sector. Energy, the obvious one. This is the most direct beneficiary of everything I've described. Oil above $100 means energy companies are generating extraordinary cash flows. Exxon, Chevron, ConocoPhillips, Devon Energy, these companies are essentially printing money right now. Devon Energy is a particularly interesting case. Raymond James upgraded it to a strong buy with a price target implying another 40% gain from recent levels. Devon just completed its merger with Coterra Energy, and analysts expect it to divest some assets and use AI more aggressively than its peers to drive efficiency. Analysts are calling it one of the best positioned operators in the energy sector. The caveat: energy stocks are the most Iran peace deal sensitive investments in the market. If a deal gets signed and oil drops 20% in a week, energy stocks go with it. But in the current environment, no deal in sight, Trump calling the ceasefire on life support, the energy trade has fundamental tailwind. Commodities and real assets. FE copper hit a record close yesterday of $6.4605 per pound, up over 13% in 2026. This matters because copper is the essential metal of electrification. It goes into everything from power transmission lines, to electric vehicles, to AI data center wiring. The combination of AI infrastructure build-out demand and supply constraints from geopolitical uncertainty has copper in a structural bull market. Real assets broadly, commodities, infrastructure, real estate that generates actual cash flow, tend to outperform in inflationary environments because their revenue streams rise with prices. FE defense and aerospace FE. This one should be obvious given the geopolitical context. Government defense spending increases when geopolitical tension is elevated and sustained. We're in the fourth month of the Iran conflict. Defense budgets globally are being revised upward. U.S. defense contractors have structural tailwinds for as long as the conflict continues, and potentially even after, as governments rebuild depleted stockpiles. Semiconductors, the AI exception, FE here, is the interesting wrinkle in the inflation is bad for growth stocks thesis. The AI semiconductor trade is partly insulated from the inflation FE rate dynamic because its earnings growth is so strong that it can justify high valuations even in a high-rate environment. Intel has tripled since late March. AMD, Micron, Broadcom have all doubled. The earnings growth driving these moves, 28% blended S&P 500 EPS growth in Q1, with tech sector margins at record 29.1%, is real. AI capex spending from Microsoft, $190 billion planned for 2026, Meta, up to $145 billion, Google, and Amazon is flowing directly into semiconductor revenues. Nvidia reports May 20th, that is 8 days from today, and Goldman Sachs analysts expect a beat and raise quarter. The bar is high, but the fundamental demand is real. FE consumer discretionary. The most vulnerable FE when inflation runs at 3.7% and gas costs $4.50 a gallon. Consumers feel it. Discretionary spending, restaurants, retail, entertainment, travel, gets cut first. McDonald's was down 2.8% yesterday. Nike, down 2.56%. These aren't random moves. They're the market starting to price in consumer stress. The key data point to watch, retail sales. When retail sales start missing estimates consistently, that is the signal that the consumer is cracking under the inflation pressure. FE utilities and REITs, rate sensitivity trap. FE these sectors were supposed to be the beneficiaries of rate cuts. People bought them because they yield dividends that look attractive when rates are falling. But when rates stay elevated, as they now clearly will, the dividend yields on utilities and REITs look less attractive relative to risk. Free treasuries, money flows out, prices fall. FE long duration bonds, FE if you own long-dated treasury bonds, 10-year, 20-year, 30-year, a sustained period of above, target inflation is bad news. Higher inflation erodes the real value of those fixed coupon payments. The bond market has already started pricing this. Yields up, prices down, watch the 10-year today. FE unprofitable growth stocks, FE companies that are burning cash and relying on cheap financing to fund their growth are punished in a high inflation, high rate environment. The era of growth at any cost ended in 2022, and this environment keeps it buried. I want to zoom out and put this moment in historical context because we have been here before. Not exactly, but close enough that the history is instructive. The year was 1973. The OPEC oil embargo began in October of that year, when Arab members of OPEC imposed an oil embargo against the United States in retaliation for U.S. support of Israel in the Yom Kippur War. Oil prices quadrupled almost overnight. Inflation, which had already been elevated, surged. The Fed was caught between fighting inflation and supporting an economy facing a supply shock. Jay Hatfield, CEO of Infrastructure Capital Advisors, made this comparison explicitly yesterday. It is just simply unmitigated disaster to have rising energy and related energy commodities. He drew the direct parallel to 1973. The S&P 500 fell roughly 48% from its January 1973 peak to its December 1974 bottom over that 2-year period. Now, I want to be careful here. I am not predicting a 48% drawdown. Today's situation is different in important ways. The AI earnings boom is real and significant. Corporate balance sheets are generally in good shape. The banking system is not in crisis. Global oil inventories, while being drawn down, were unusually high heading into the conflict, which has cushioned the blow. But the parallel is worth understanding because 1973 teaches us two things that are directly applicable today. Lesson 1. Supply shocks are harder to fight than demand shocks. ***, the Fed's tools are designed to manage demand. They are nearly useless against supply disruptions. In 1973 to 74, the Fed tried to fight inflation with rate hikes while the economy was already weakening from the oil shock. The result was stagflation. Rising prices and falling growth simultaneously. We're not there yet, but the risk is real. Listen to, the market can stay elevated longer than you expect, and then fall faster. In 1973, the stock market didn't crater immediately when the oil embargo started. It took months of deteriorating fundamentals before the real selling began. The same dynamic could play out today. Stocks holding near all-time highs on AI earnings strength, while the macro deterioration accumulates underneath until something triggers a faster repricing. The question investors need to ask themselves is not will the market go up or down today? It is my portfolio positioned for an environment where inflation stays elevated, the Fed can't help, and geopolitical risk remains a constant? If the answer is no, if you are concentrated in rate-sensitive sectors, consumer discretionary, or long-duration bonds, this CPI print is your signal to reassess. Alright, let's make this practical. Here's what I'm actually thinking about doing in this environment, and here's the framework I'd use to think about your own portfolio. Phase step 1, diagnose your inflation exposure. Pull up your portfolio right now. Look at every position and ask, how does this position perform if inflation stays at 3.5–4% for the next 12 to 18 months? Companies with pricing power, the ability to raise their own prices as their costs rise, will survive. Companies without pricing power will see margins compressed. The companies with the strongest pricing power right now, energy producers, they literally sell the thing causing inflation. Semiconductor companies with irreplaceable products, consumer staples companies with dominant brands, infrastructure operators with long-term contracts indexed to inflation. The companies most vulnerable, pure-play consumer discretionary with no brand moat. Companies with significant debt that needs to be refinanced at higher rates. Long-duration growth stories where valuation depends entirely on future cash flows, discounted at low rates. Step 2. Review your bond exposure. If you hold long, duration bonds in your portfolio, either directly or through bond funds, today's CPI print is a direct negative for those positions. The longer the duration, the more sensitive to inflation expectations. Consider whether shortening duration makes sense. Moving from 10-year bonds to 2 to 5-year bonds reduces your inflation risk while still generating yield at 4.4%. The 10-year does offer real income, but if inflation stays at 3.7% plus, your real inflation, adjusted yield on that 10-year is less than 1%. Short-term treasury bills, yielding around 5% with almost no duration risk, look relatively attractive in this environment. Step 3. Think about the Iran deal as a binary event. Here is a framework I find useful. Think of your portfolio as having two separate performance scenarios. Scenario A, Iran deal gets signed, oil drops rapidly, maybe 20 to 30%. Energy stocks fall hard, consumer discretionary rebounds as gas price relief flows to household budgets, inflation expectations drop, rate cut bets come back, the rotation trade out of tech into rate-sensitive sectors, resumes. Scenario B, Iran deal falls apart or drags on, oil stays above $100, inflation accelerates further, no rate cuts, consumer stress grows, energy stocks continue to outperform, tech's AI earnings keep it elevated but the broader market faces headwinds. Given Trump's rejection of Iran's proposal yesterday and his characterization of the ceasefire as on life support, scenario B is the higher probability outcome in the near term. But deals can happen suddenly. Don't position so heavily in one scenario that a surprise peace deal causes catastrophic losses. Step 4, keep some dry powder in environments of genuine uncertainty, and today's CPI print is a genuine uncertainty catalyst. Having cash on hand isn't cowardice. It is optionality. If markets sell off hard in reaction to this report, having cash means you can buy quality positions at better prices. If markets absorb it well, you've given up some upside, but you've also avoided the risk of being forced to sell at the wrong time. Step 5. Watch the May 20 Nvidia earnings as the next major catalyst. Everything I've described today, the inflation pressures, the geopolitical risk, the Fed constraints, exists alongside the AI earnings, boom, which is very real. Nvidia's report on May 20 could either validate the AI bull case and give markets a reason to push higher despite the macro headwinds, or disappoint and remove the one remaining pillar holding the market at all. Time highs, Goldman Sachs expects a beat, and they've raised their EPS estimate 12% above consensus. But they also warned the bar for stock outperformance is high. Watch that date. Let me bring it all home. Here is what today's CPI report actually means. 3.7% inflation is not a crisis. It is not 2022. The economy is not collapsing. But 3.7% in the context of an unresolved war that is keeping oil above $100. A Fed that cannot cut rates, a peace deal that Trump just called totally unacceptable, and a stock market sitting at all-time highs with only 37% of stocks actually advancing. That is a setup that demands clarity, not panic. Clarity. The investors who will do best in this environment are not the ones who predict perfectly what happens next. Nobody does that. They're the ones who understand the forces at work, know what their portfolio is actually exposed to, and have a plan for multiple scenarios. That is what we build here. Every single video, here, is what I need from you right now. And I want to be honest about why. This is a new channel, **3 videos in, and the only way it grows, the only way I can keep bringing you this level of analysis every week is if you engage. So here is what I am asking for. Faith first. If this video gave you one thing you didn't know before you clicked on it, hit the like button. **, right now, it takes 1 second. And for a channel at our stage, 1 like is worth more than you know to the algorithm. Drop your answer in the comments. **, after watching this video, are you making any changes to your portfolio? Just tell me yes, no, or thinking about it. That is it. 3 choices. I read every comment. I'll respond to as many as I can today. Third, subscribe. Because next week, when Nvidia reports on May 20, I am going to break down exactly what the numbers mean and what you should do with your AI positions. You don't want to miss that one. Subscribe now so YouTube actually shows it to you. We're building something real here, a community of investors who think clearly, act deliberately, and don't get jerked around by the noise. I'll see you on May 20th.